Hey, what's up, everybody? It is Wednesday, August 3rd. So we had a nice bounce in the market today. Actually, not just a bounce, but a resumption of the rally, which is this is what's supposed to happen. Yesterday, in my video, I said I was a little bit surprised by the pullback, and I blamed it on emotional headline trading. You know, yesterday we had the Nancy Pelosi in Taiwan and the whole Taiwan-China jitters, and then we had the Fed come out and squash all this chatter about a pivot. I'm going to talk about that in a minute. But so really it was one of those days where actually the market gave you an opportunity to buy. I said yesterday I was adding to my stock portfolio. Today it was up nicely. And so that's what you have to do. You cannot fight these flows. People, I know that maybe some of you, hopefully not a lot of you, you probably got scared yesterday. You probably get scared when you hear this rate hike talk. And what I'm trying to impress upon you is the fact that monetary policy is basically irrelevant in the big picture. It is it's price setting, yes, but we're not talking about the 1970s type of rate increases. And it is a fiscal operation, so essentially it is a fiscal expansion. The government is a net payer of interest. So I ignore them, and you have to understand too, and it's what I've been saying, is that 100%, you know, we could call it 99.999, let's just call it 100% of the financial community, the investor community, all they look at is monetary policy. They see everything that happens through the lens of monetary policy. They don't understand anything else beyond that. So whatever happens, they have to frame that in the context of monetary policy. For example, right now the market's going up, and again today I saw tweets and comments to the effect like, oh, people are buying in anticipation of a Fed pivot. I mean, yes, yesterday the Fed just said we're not going to pivot. You know, they just totally squashed that whole thing. But today, because the market is going up, these people have to come up with some kind of an explanation that fits within their world of everything being monetary policy. So now they're saying, well, they're buying in anticipation of an eventual Fed pivot. Folks, it's all about these fiscal flows. I mean, we can go all the way back to the beginning of this year when I was talking about the deficit starting to fall, and then I said in April we're going to get a big tax drain, and I said after April the money will start to be spent back out again, the swimming pool will start to get filled up. We had another tax drain in June with the quarterly corporate tax payment. I said that was a little bit of a setback, but since then I said the market will recover the mid-June highs, which the NASDAQ already has, and the Dow and the S&P will ultimately follow that. The pool now, I mean, all of that drain since April, and this is like the 100th time I've said this, all of that drain since April has been put back in with an additional 50 billion. The deficit right now, the federal deficit is just under $1 trillion. It's probably like around 940, 950 billion. By the end of this month, we'll be back over $1 trillion. That's very good because the deficit of the government equates to an addition to the financial balances of the non-government, of the economy, of us. Not all equally distributed, but that's that swimming pool. It's filling back up. That's still down a lot from last year, so we're not going to grow at the growth rates that we saw last year. But we should have positive GDP growth in the third quarter at least, and hopefully in the fourth quarter as well. Okay, this month, once again, I will repeat, is going to be a big bullish month. We have a quarterly interest payment. The fiscal flows will be very strong. And I just said that by the end of this month, by the end of August, the deficit will be back over $1 trillion. So it's funny because, you see a lot of economists now talking about how the deficit has shrunk. Like I was telling you this back in January and February and March and April. It's actually been going back up now. So you're not going to hear that from the mainstream. You're not going to hear that from anyone except basically from me because, I'm on top of these things on a daily basis. You're not going to get this information anywhere else. And, my subscribers, they get this information throughout the day. Like yesterday, the update was to buy that dip. All right. I sent out another email today with regards to oil. I mean, if you're interested in that, you got to go sign up for a 30-day free trial, at least of my report, MMT Trader. You're not going to get this information anywhere else. It comes to you from me way before, well before anyone in the mainstream financial community or the media or anybody else brings it to you. So, like I said yesterday, and like I've been saying, we're all on track. It's going to be a positive month. September is a month that you got to anticipate probably we'll see a pullback in stocks because by mid-September we'll have another quarterly corporate tax payment. That's going to be a drain of about 100, 106, 110 billion. That's not the massive drain we saw in April and June. That was almost back to back. I mean, we had April 324 billion. We had a little bit of a bounce back of in May, and then we had another big drain in June. So that was a big hit. But we're going to get a hit of about 106 billion in September. Market will pull back. And probably, we'll resume the rally sometime in late October or November. That's usually what happens. That's seasonal. I talked about that stuff yesterday, how these seasonal patterns, there's a reason for these seasonal patterns. I think you can understand that now. I mean, it's all about these flows. But again, you're not going to hear that anywhere else. All of the talk you're going to hear is going to be concentrated on monetary policy. It's going to be a discussion or just like a fixation with, is the Fed going to pivot? That's going to be the new thing now. And no matter what the Fed says, like yesterday, there were a number of Fed officials who, just squashed that right down. But today, the comments that I saw were right back again. This must be, like in their mind, this has to be a rally because the Fed is going to pivot. It's people anticipating a Fed pivot. And it's totally irrelevant. I mean, if the Fed pivots, great. But, and it very well could eventually because, like I've said in the past, if there's one thing that Powell has shown himself to be, it is a follower of the market chatter and what the market expects. I mean, we've seen this time and time again. So I think if the media and the pundits keep repeating this mantra of Fed pivot, he might fall in for that. But right now, there's no conversation about that from the FOMC. But I don't pay attention to that. It's irrelevant. It may only be relevant in the behavior of people, but if they pivot, you know what's going to happen. I mean, everybody, the monetarists automatically assume that that is a bullish thing. The other thing we're still waiting for, which hasn't happened yet, is QT. I mean, quantitative tightening hasn't happened yet. Powell, last week in his press conference after the Fed meeting, he said it's being held up because of settlements of securities that the Fed holds. I'm not really sure what he meant by that. I think he probably meant redemptions. I don't know, but it's being held up. So the QT is maybe not going to be that smooth on a monthly basis. You know, they were looking at the first 3 months, 47.5 billion, then going to 95 billion a month. There's just been a fraction of that done. I think the total balance sheet, I think I said this in a prior video, was down something like, since the beginning of June, down something like 26 billion. I mean, that's nothing. You know, right now it should be down over 100 billion. So they really haven't gotten it going, and I think when it starts, it could, you know, you could have a couple of big weeks or a week or two that are large, and then they catch up eventually, if they do it. And if they do it, you know, that's the thing I've been waiting for. One of the things, I mean, I've been waiting for since way back in probably, you know, March, when I was saying I cannot wait until they start this QT, because everybody thinks it's so bearish and, you know, it's draining out the liquidity, when in fact this is exactly what the banks want. I mean, they are very aggressive now, even given current conditions where you have, you know, high levels of reserves in the system. Lending is really flowing out of the banks, and if the Fed gets on the ball with QT and starts to reduce reserve balances, that would just free up a lot of balance sheet space for the banks to increase lending. And, you know, as I pointed out, household debt burdens as a percentage of disposable income, in other words, the difficulty of servicing debt on a monthly basis in the aggregate. I'm not talking about, you know, you could cherry pick individuals here and there, or maybe your own situation if that's the case. But in the aggregate, in the big picture, household debt service burdens are near an all-time low. They are nowhere near the level we saw in 2007, when debt service burdens were up around 13.6% of disposable income. Now they're about 9.4, 9.6% of disposable income. And that figure has just been revised lately. So even with the interest rate increases that we have seen so far this year, those debt service burdens have not increased that much. So what does it mean? It means that the ability of the non-government to take on more debt, I mean, it's there. And that, for me, again, I keep saying that bank stocks are the most attractive sector of the market, I think, right now, for two reasons. Number one, the potential for loan increases, it's huge once the Fed gets going with this QT. And loans, you know, that's how banks primarily make their money. But the other thing is that the Fed rate hikes, the Fed's got to pay $75 billion in interest on reserves, and that doesn't even include interest on what's held in the reverse repo facility. I mean, when you include that, you know, it's huge. What are we like? Almost 6 trillion. At 2.25 is 125 billion, 120 billion that the Fed's going to have to pay. That's free money going to the banks. I mean, it's huge. If Congress came out today and said, "Hey, we're going to give 120 billion to the banks," that's another thing that cracks me up, is that we just, by the end of this month, by the end of August, there will have been a 500 billion net fiscal flow to the economy. Can you imagine if Congress came out and said, okay, we're gonna do a stimulus of 500 billion over the next 4 months? I mean, the market would go crazy. But that is exactly what is happening. I mean, we had, what, 370 billion so far since that tax train in April, let's call it since the beginning of May. And by the end of this month, it'll be over 500 billion. So that's why the market is going up. The same reason, like if Congress sent out 500 billion worth of checks, that's why the market is going up. I mean, it has nothing to do with, this is why it's funny, because we've had 4 rate hikes and these monetarists, they're going nuts because they're like, why is the market not crashing? We've had 4 rate hikes. Maybe it's just going to take one more rate hike. I mean, because again, I mean, if you only see it through the lens of monetarism, you're not going to get it. But I mean, 500 billion has just been put back into the economy. Not even put back, put in. You got the 300 something billion that was drained out, plus another, we're 500 billion by the end of this month. I mean, that's the same thing as saying, what if Congress sent out 500 billion worth of checks? If that happened, if they said that, you know what would happen. The market would be going straight up. Well, it is going up. It's just not going up on the basis of that understanding. Like, people don't understand that. They don't get it. It's not something that they look at. It's just not something that they understand. I mean, these fiscal flows are everything. Everything. I do every video on this. And I mean, I don't know how much more accurate you can get. So that's where we are, folks. Like I've been saying, August is going to be a big month. The swimming pool is filling back up. You don't want to sell this market when the swimming pool is filling back up. I've already given you a cautionary, outlook for September, mid-September on, maybe after the first week in September. It'll get a little bit rocky. But that's not going to be as big a drain as what we saw in the April-June period. So we'll get through that as well. So that's it. That's the update for today. Don't forget, go to my website, pitbulleconomics.com. The link is in the description. Sign up for a 30-day free trial of MMT Trader. Bye.